The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
So stock of the day is TechnologyOne, does develop, sell, support those financial management and enterprise software solutions. Customers including universities, councils, students, health and financial institutions. It will distribute a record fully franked interim dividend of 4.29 cents. That's up from 3.3 cents in the previous period. Well done, Rudi. Now, net profit after tax rising 31% in the half year to the end of March to 63 million, with recurring revenue up 19% to 265 million. Chief Executive Ed Chung has said the company's SaaS Plus offering is fueling growth, notably in its enterprise resource planning offering. TechOne saying it's increased its research and development investments by 21% in the first half of the financial year, but the company has not provided guidance. And well, we can see the market response up 12%. All right, Rudi, give it to us then. Would you still be buying? I mean, look, taking a look at the stock price, it's almost gone vertical.
Well, as some people might know, I've been on the register now for I don't know how long time. You might be surprised though. I did the numbers recently. This is not the best performing stock in my portfolio.
That's okay. What is?
Aristocrat is. So to my surprise, Aristocrat is outperforming TechnologyOne on a long distance measurement. For those who don't understand TechnologyOne, I mean, and maybe a special mentioning for the analyst at Morningstar, who's about to update his next report saying that this company has nothing special and he doesn't understand why everyone is piling in. Why is this company constantly being re-rated? Because it's all about expectations, and Philip will confirm this, and it's all about what analysts put through their models for the years ahead. And now, for a number of result releases, what TechnologyOne is able to do is they are basically forcing analysts to put higher numbers in their modeling. And I'm not so sure whether whoever did the little spiel is correct. I think they did actually provide guidance. They actually upgraded their guidance for the years ahead. And that basically means that management is expecting an acceleration in growth for the years ahead. Put that through your models, and for companies like TechnologyOne, that means that the valuation sometimes really jumps higher. That's why you see quite a meaty response in the share price on the day of release, which you normally don't see that often. And this is why those stocks seemingly always trade on elevated expectations, on elevated multiples, but it's all in the models. And if they reach their targets, which I'm assuming they're not just putting out for nothing, then this stock is worth what it is, and is worth holding in your portfolio.
All right, so
I hope that was succinct enough.
Yeah, well, a solid hold then. Where's it got to get down to start adding to it, to start buying? I mean, given what it's just where it's been to.
There are no golden rules, but I'll give you a little bit of an insight. I didn't have a full allocation recently to Xero, and about a week before the results or so, I was convinced that the result was most likely going to be strong, so I added more shares to it. Was the share price weaker? No, but I realized that if they come out with a strong result and they convince analysts that the future is bright, the share price will be higher, and the share price will be higher by 10-15%. So it's worth buying. All right? Same thing you can apply to TechnologyOne. I mean, it's easier said in hindsight. I mean, we didn't know they were going to surprise yesterday. But if you are convinced that company remains on a very strong growth trajectory, any pullback that is large enough, and that's basically the long and the short of it. There's no golden rule like it has to be 10% or 15% or whatever, because it's all in relationship to what the share market offers you. But the only thing maybe to add is, when a company like Aristocrat disappoints on the day and the share price goes down by 15% at some point, that's a buying opportunity, because it doesn't change the trajectory of that company is on. companies do disappoint at times. I remember at least 2 occasions when TechnologyOne was sold down heavily because they only grew by 7% a particular year. Imagine only 7% in EPS. And clearly, in hindsight, that was a screaming buy opportunity. I mean, they will disappoint at some point. They just didn't do it today.
Phil.
73 times PE, 1% dividend yield. What's not to like? Okay. Look, it's looked expensive for a while. Pays stuff all for dividend. Don't buy for a dividend. But this is another example of it's a great bottom draw stock that if you waited for it to look cheap, it's like waiting for Sydney property prices to look cheap.
Yeah.
You're just going to keep missing out.
Yeah.
I look at stocks in 3 buckets. Poor corporate governance, avoid. Doesn't matter what they priced at, just avoid them. Stocks that you can trade, that range trade, they're expensive, they're cheap, buy, sell. And then bottom draw stocks where, if they get too big part of your portfolio, don't let them become 50% of your portfolio, take some profits. But bottom draw, just don't think about them. TechnologyOne, Commonwealth Bank, Wesfarmers, maybe CSL. They might look expensive 5-10 years' time. They'll be a lot higher because this is one of those stocks. Despite being expensive going into this result, it was only a half-year result. Half-year consensus isn't as accurate as full-year. It beat on almost every measure.
Yeah.
And they upgraded their full-year guidance. I think now profit expected to be 12 to 16% growth, following 33% growth in the first half. Now that doesn't mean it's symmetric, but you're tracking a growth rate above your guidance in the first half. That doesn't mean they're even first half, second half, but it's a good suggestion that maybe their guidance is conservative. They grew in government, they grew in education, they grew in Australia, they grew in the UK. Tick, tick, tick. There'll be upgrades overnight. The quants will buy this tomorrow. So I just can't bring myself to call it a buy. I would buy on a dip, but it is a genuine hold, bottom draw. Rudi will call you and say, take profits, ignore him. Just keep it in the bottom draw, and I'll call it a long-term hold.
What's important as well is their forecast for the recurring revenue is now going to $1 billion.
Yeah.
How strong is its UK business? So what, 6 contracts there?
It's emerging. So it's basically what they've done is they for a very long time have carefully chiseled their way in the UK. My understanding is from the UK that it's a large market, but it's very old-fashioned. It has very old technology. So basically, TechnologyOne is moving in, and they're coming back. It's middle like zero. I mean, we are well above the competition in terms of product offering. They've acquired a UK company at one stage, and that has really accelerated their. And they're obviously now making. They're basically competing against large companies that have very old technology, and they obviously have to wean away customers from those companies. But if you have the better product, you have a superior product, well, there's probably more growth to come there.
Well, there you go. That is a very solid hold then for our stock of the day, TechnologyOne.
The day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.